And welcome back to Berman's Call. I'm here, of course, with Larry Berman, and it's time for Larry's educational segment. Larry.
So the Fed in their meeting this week is going to be debating how to reduce the balance sheet. They've got $4.5 trillion in total assets there. I think we're in a liquidity trap because when I evaluate it, and I'm going to go through the evaluation, I don't think we can get back to 3% growth, and I don't think they can raise interest rates very much. If we look at what a liquidity trap is defined as, that's basically, in Keynesian terms, they're flooding all this money in and it's not doing the job at the end of the day. So they've been doing this for a long time. Let's look at quarterly GDP. That's the white line here on the graphic, going back 20 years. And the 20-year average is this orange line. And it's been falling constantly from a rate of 3 or 4%, decades ago, currently sitting at a rate of around 2.3. But if we look at since the 34 quarters, since the Lehman moment, we've been running at 1.5%. And so all this money that they're creating by way of quantitative easing, etc., really isn't working. Now, let's look at the Fed funds rate, because here's going back 20 years. You had the long-term capital default in 1998, the Russian default in there, where all the central banks cut rates, going into slowing things down in 2000. This was the first time basically interest rates fell dramatically. Greenspan took interest rates to 1%. They took them up again going into the crisis in 08 and 09, and basically we've been at zero ever since. And this is the 5-year average of short-term interest rates. So the Fed, if you look at their long-term target, is thinking 3% is where we can get back to. Nothing like what it used to be, okay? So I don't think we're going to get there, because as you look at what's happened where they've started to raise interest rates. So now we're going to look at the U.S. yield curve, 10 years minus 2 years, okay? So when the curve inverts, this is when a recession risk is the highest. Now, the curve today is not saying, hey, there's going to be a recession. But since they started raising rates right here in December of 15, the curve has basically been flattening. And what that means is the economy's not handling higher interest rates well. And they've only raised interest rates come off zero a little bit. Let's look at the Fed balance sheet, okay? So this is an important thing here. If we look at the Fed balance sheet and look at so here's QE1, and that was the first big increase in the Fed putting money on their balance sheet. QE2, there was a twist where they extended maturities, and then QE3. And ever since, it's been flat. And now we're starting to hike rates. So what they would like to do long term is probably bring this back to about 2.5 to 3 trillion, because there's just more money needed today. And so they want to start selling off some of the long bonds, and that theoretically would force interest rates up. But here's what I look, and here's my biggest problem. Here is the deficit, annual deficit for the last 20 years as a percentage of the economy. So there's zero on the economy. The last time the economy was actually growing without the deficits was in 2000. The only reason the economy is growing these days, Paul, is because governments have been running these massive deficits. And if you look at the Congressional Budget Office and what they project going forward in the Trump administration and beyond, it's catastrophic, the debt that's coming. And that's the only way we're growing. So I don't think we can normalize things here. The only way we've grown since the tech bubble burst is with all this massive amount of debt spending. And Paul, since the Lehman moment, that's been 1.5%. So the economy is very, very weak if it wasn't for all this government spending. So they're debating the debt ceiling now, and all this is nonsense because they just have to keep spending and spending and spending. And I think it's toxic long-term for growth. We're not going back to 3% growth. I know it's a dismal outlook, but the demographics will just not support it in my mind.
That's Larry Berman with lots to say about the U.S. economy and the debt ceiling and the debt situation in the U.S. We're at the end of our program, so we thank you very much for watching. We thank in particular those that emailed and called us with their questions. Great questions, as always, from our viewers. That's it for us on today's show. See you next Monday.